Hello investors and future investors, welcome to the channel. For today's video, I'm going to be showing you, even if you are trading with a micro account or you only have $100 in your portfolio, I'm going to go ahead and show you how you can use that in order to generate income. Now, for those of you that are new to options or you're trying to use options in order to make some additional income, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you how to use just $100 in your current portfolio in order for you to make income. So those of you that are trading with a micro account, do not worry, this video is specifically for you. Now, before I go ahead and get into this video, I just want to let you guys know this is going to be the second edition to the first one I posted. I did show you how to use $100 with a simple option strategy. This is going to be a continuation of that video. I'm going to be showing you a different option strategy using the same $100. Now, if you guys only have $100 in order to trade with, then you could go ahead and do option strategies because there's only 3 ways to learn options. That's going to be practice, practice, practice. Another way you could go ahead and learn options trading is to go ahead and take that $100 and deposit it into a new Moomoo account. Moomoo have lots of features that can actually help you with your options trading. Now, most of you guys have asked me, and if you go over to the features right here, you could see Moomoo allows you to paper trade. If you guys are afraid to go ahead and start trading options live, then you could go ahead and use the paper trade option right here. I want to show you one more feature you can use. If you go ahead and deposit that $100, you're going to be able to get an 8.1 API on your uninvested cash. Moomoo also does crypto trading, and there's 13 option strategies and 9 order types. Now, I know you guys probably don't know what these are, but do not worry. I am here to teach you. So go ahead, make a deposit in Moomoo. And if you guys want to go ahead and help the channel, then my link for Moomoo is going to be in the description below. Now, let's go ahead and use that $100 in order to make income right away. For today's video, we're going to be using none other than the Spider ETF, and that ticker is going to be SPY. For those of you that do not know, the Spider ETF right here stands for Electronic Traded Funds. What that is, it comprises 500 of the US best and most profitable stocks. So what they do is that these stocks come together to create a fund. So what we're going to do now, we're going to go ahead and trade that ETF in order to make money. So we're going to go down. We're going to look for trade SPY options to the bottom here in order for us to go ahead and open up our options chain. Now, right here, you see all this information that says buy, sell, call, put, and expiration date, and also the share price. Everything here is known as the option chain. What the option chain does is that the option chain gives us enough information in order for us to go ahead and make a very informed decision before entering any option contract. Now, speaking of option contract, before we get into detail about these option strategies, I want you guys to do yourself 2 favors. Favor number 1, always make sure to do your own due diligence before investing. What might work for my portfolio, quite frankly, may not work for you. The second favor I need you to do yourself, always make sure to have an exit strategy before entering any options contract. That way, if the trade do decide to go against you, then at least you know how to get out of the trade. And lastly, these videos are for education and entertainment purposes, and everything in these videos represent what I am doing with my personal portfolio. So, the strategy for today is going to be using $100 in order to make income using the Spider ETF. So here it goes. We're going to go ahead to sell. We're going to go ahead to call right here. And now we're going to be choosing our expiration date. Now, the Spider ETF usually offers expiration date every single day. So that allows you to do more trade. What we're going to be featuring today, we're going to be doing weekly expiration date. So we're going to go ahead and look for something with about 5 days to expiration, and that's going to give us November 17th. Now, I want you guys to make sure you pay attention to this. You see November 14th right here, and you also see November 17th. A couple days are missing. That's going to be the weekend days. With this option strategy I'm going to be showing you, it works out, especially if a weekend comes between the days, because you're still going to be making money. Because this option strategy deals with what's known as theta, but that's going to be for a different video. So let's go ahead. We're going to select November 17th, which gives us 5 days to expiration. Now that we have our sell, we have our call, and we have our weekly expiration date because you want to use $100 weekly in order to make income. Now we're going to go ahead and we're going to choose our strike price. The strike price we're going to be looking for is going to go ahead and be above the current share price of 682. So we're going to go ahead and we're going to choose that. Now, the rule of thumb, if you are new to options trading, what you want to do is that you want to go with around an 80% chance of profit. If you look to the top here, you can see chance of profit featured here. So that's going to give you the 690. Now, what I'm going to do, I'm going to go even higher, and I'll explain to you why as the video goes along. So what I'm going to be doing, I'm going to be taking an 87% chance of profit right here, and that's going to coincide with the 692 strike price that I'm circling right here. So we're going to go ahead and we're going to select that. Now, secondly, what we're going to be doing, we're going to be flipping the switch right here. We're going to be going to buy now while maintaining our call and maintain the exact same strike date. That's really important. And now we're going to go ahead and choose our secondary strike price. And to keep the video very simple, the secondary strike price is going to be right above the previous strike price that we just chose. So we chose the 692. We just go ahead and choose the 693, which is right above it. Let's go ahead. We're going to select that one. This option strategy is known as the call credit spread. The call credit spread is known as a bearish option strategy, meaning if you do decide to go ahead and implement this option strategy in your portfolio, you're off the mindset that this current share price is going to stay where it is, it's going to trade sideways, or it's going to go down, or even if it does go up a little, it's not going to hit your bottom strike price of 692. Hence, it's a bearish option strategy. Now, the other thing about this option strategy, the call credit spread, is that it's perfect if you're trading with a small account, specifically if you only have $100 in your portfolio. Let's go ahead to continue. Let's go ahead to review order. And there you have it. One of the most important criteria in order for you to go ahead and do this option strategy is that you need to have a minimum of at least $100 in your portfolio. So as you can see here, the collateral is $100. Now, I just said I want to make sure I choose the strike price right above the other strike price, and here's the reason. The difference between your 693 strike price here and your 692 strike price here is going to be $1. $1 multiplied by 100 is going to give you $100, and that's where we got this $100 collateral from. Now, where did we get the 100 shares from? Well, I'm glad you asked. Each option contract, as we do this here, this call credit spread, you see one right here. This is going to be one option contract. Each option contract does contain 100 shares. You can see stated right here. So hence, you multiply your $1 difference between your strike prices by 100 shares, and that's going to give you your $100 right here. Now, the other good thing about this option strategy is that it's what's known as an income generating option strategy, meaning whenever you go ahead and decide to implement this option strategy, you're going to be getting paid right away. For this particular option, the amount of money you're going to be getting paid is going to be $15.92. We're going to round it up to $16. This $16 is going to be representative of your ROI, or your return on investment. Now, before I show you the return on investment, here is one of the key factors for this option strategy. This $16 that you're going to be receiving here is going to be yours to keep no matter how the trade goes. Hence, an income generating option strategies. You get to keep that no matter what. Now, one of the most important things you need to always focus on when you're doing these option strategies is not really the monetary value. What you want to focus on is your ROI, the percentage return you're going to be getting. So in order to calculate your ROI, you're going to be dividing your $16 right here by your $100 you left as collateral. And that's going to give you around a 16% ROI. A 16% ROI is an extremely high ROI. Just as an example, this ETF here, the Spider ETF, it usually gives an average return, an annual average return of 10%. Within just 1 week, you are able to make 16% return. It's quite possible. So I really like this option strategy because it has a very low barrier to entry, meaning you only have to have $100. So anyone trading with a micro account could go ahead and do this. The second big reason I like this option strategy is because it's an income generating option strategy. So whenever money you receive, you get to keep that. That's always going to be yours no matter what. Now I'm going to go ahead and explain a couple more things to you before I go ahead and show you how this trade is going to work out. Because one thing about this option strategy is known as a defined risk option strategy. So what we're going to do, we're going to go down here to the expected profit and loss. This just summarizes the amount of returns that you could possibly get, right? So if you follow this green line right here, I want you to pay attention to this $16 right here. And then right here, you see the share price is moving. As I move the line, you could see right here, the share price for SPY is going up or is going down. However, your return right here does not move. Hence, this is a defined risk option strategy. The amount of money you could make, that's all you can make. The amount of money you use as collateral, that's all you can lose. So as you can see to the bottom here, you can see the amount of money you could lose now is not going to be $100. The total amount of money you could lose is going to be $84. How did we come up with the $84? Well, it's quite simple. Your option collateral is going to be $100. However, when you do the option strategy, you receive $16 right away. You're going to subtract your $16 from your $100 collateral, and that's going to give you that $84 that you see here. And that is the maximum you could lose. Hence, a defined risk option strategy. The defined risk is that you cannot lose more than what you put into it. Now, I want to show you guys one more thing. Let's go ahead. We're going to go to sell right here, and we're going to remove this. So now this one is not a defined risk because as you can see, once I move the line right here, let's focus right here again on the expected profit and loss. As I move here, you can see that is going up. So in this scenario, your expected profit or loss is going to be unlimited. Well, in this case, it's just going to be the expected profit. You stand to gain as much, it never stops until the expiration date comes about. So that's the difference between a defined risk option strategy and an undefined risk option strategy. So let's go ahead. We're going to put this back right here. And let's go ahead. We may have to refresh it. Let's go review order. There you go. Now, there's a couple of ways in which this trade could go. Now, this is the one you want. Come expiration date of November 17th, ideally, you want this share price here to remain below this 692 price here. The 692 price right here, remember, that's your sell call price. Now, once this share price stays below your 692 strike price, then you get to keep your $16. Remember, we did say that's yours to keep no matter how the trade goes. But now your $100 of collateral that you left, that is now released back to you. And if you so choose, you could go ahead and do three things. You could rinse this option strategy. You could go ahead and repeat this option strategy and you keep locking in your investment gains. Your investment gains is, in this case is going to be the $16 or whatever credit you receive. Now, all that glistens is not gold. Every coin does have two sides. So the other way that this trade could go, come again, expiration date of November 17th. And remember, you do not need to wait until expiration date in order for you to exit these option strategies. I'm going to explain that to you in just a second. So come expiration date of November 17th or before, if this share price right here happens to go up and it surpasses your 693 strike price, which is going to be your buy call strike price, then you get to keep your $16. That's the best part. That money is always yours no matter what. However, you're going to lose your $100 collateral. And I just showed you the entirety of your loss is not going to be $100. It's going to be $84. You're going to subtract the money you received from the collateral, and that's going to give you $84. Now, here is one of the key things about this option strategy. When you're doing these option strategies, you do not need to wait until the expiration date. Remember, I did mention at the start of the video, always have an exit strategy in mind before entering any option contract. Me personally, what I do, whenever I'm up on the trade about 50% or more, I go ahead and I close out the trade. Depends on what the market is showing that day, whether the market is bullish or bearish. So in this case, if you're up about $8 on the trade, you're going to close out the trade. You're going to lock in your $8. You're going to get your $100 back. Remember, do not focus so much on the amount of money. Focus on your return on investment. So your $8 is going to give you 8% return. Now remember, the best way to make money in the market is by compounding. That $8 return is going to be an 8% return. Remember, you get to keep your $8 and you get your $100 released back to you, as opposed to waiting until expiration date where you might lose a lot more than the $100. So me personally, once I get 50% up on a trade, I usually go ahead, close out the trade, and I go ahead and do the trade again. One last thing I want to bring to your attention. I did promise you I'm going to show you this. Now, the reason why I went ahead and I went above the actual price of the 80% price, there's actually two reasons. The number one reason is before you go ahead and do this option strategies, what you could do is go ahead and look for the expected move of the stock. So in this case, if the share price had to go up by this particular date, the expected move is going to be 689, which is going to be this price right here. So by going a bit higher, I just give myself some extra cushion just in case. Now, I did show in my last video the expected move. So just go ahead and check out that video. Everyone could go ahead and check out the expected move. It really helps increase the odds in your favor. Now, the other reason why I went ahead and chose a higher strike price is because this option strategy, like I mentioned, is a bearish option strategy. So right now we're in a bullish market. So by doing this option strategy right now, I'll actually be betting against the market. If I am going to be betting against the market, then I want as much odds to be in my favor as possible. Hence, I went all the way higher to choose an 87% chance of profit as opposed to down here, which is an 80% chance of profit. So those two keys are really, really important. Always check to find the expected move, and whatever the expected move depends on how your sentiment is that day. You could go ahead and go even higher, or if you're less risk adverse, you could go ahead and go lower. Now, if you do decide to go ahead and choose lower strike price, you're going to be at more risk. However, you will be receiving a lot more income. So there you have it, investors and future investors. This is how you use $100 in order for you to make income. The most important thing is to make sure you know what you're doing. Make sure you look for the expected move. Make sure you close the trade whenever you're up 50% or more, depends on whatever you choose. And also make sure you give yourself enough cushion above the expected move. And if you're betting against the market, you want to give yourself enough room so the trade could work in your favor. So the call credit spread is a perfect option strategy if you're trading with a small account of only $100. Now, the video before this, I did show you a different option strategy, which was a bullish option strategy that can be used if you're trading with just $100. Now, the next video, I'm going to show you how to put both of these option strategies together, together, and make a completely different option strategy. And now your returns are going to be increased and your risk is going to be lowered. So if you haven't already, now would be a good opportunity for you to go ahead, like the video and subscribe to the channel. Now, for those of you who made it to the end of the video, you guys are the real investors and future investors. If you guys have any questions about this option strategy, the call credit spread, or the option strategy in the video that preludes this one, the put credit spread, then let me know in the comments below. Now, until the next video, keep pushing your investments.